Hi, I'm Michael Merrigan, founder of Shadmoor Advisors, and this is the Shadmoor Overlook series. We're joined today by our special guest, Matt Kinsel, partner at Fieldstone Insurance Group. Matt, great to see you, and thanks so much for joining us today.
Thanks so much for having me. Pleasure to be here.
Would love to learn a little bit more about yourself and Fieldstone.
Yeah, so I've been at Fieldstone 12 years now. Fieldstone is a specialty brokerage really centered around asset managers. That's historically been our large focus. And we try to make ourselves a one-stop shop for the community. We fully understand, the time limitations that funds have. And while they understand insurance is important, we know it's certainly not top of the list. So we try to position ourselves as a one-stop insurance shop. We offer the commercial insurance for the management company and the funds. We can help with employee benefits on a domestic or international basis. We do life insurance and estate planning, and then we can help with the personal insurance for the C-suite team.
Okay, great. I think that a lot of people watching this are probably ODD professionals, investment allocators, or investment managers.
Yep.
And a question we often get is, how do I know what types of insurance I should be purchasing?
I think something we've done historically for our clients is build out like an ODD template, right? A spreadsheet that specifies all the different types of insurance that we think the portfolio company should have. We then work with them to see, get a little peek under the hood. What are the policies they have? What don't they have? We conduct a little gap analysis. And based off that, we can bring it back to the team and say, hey, based off this, our findings are they have holes here, they're strong here, lay out the path forward and go from there. But I think the big thing that's often overlooked during this diligence is, say, the D&O of the portfolio company.
Okay.
If you have folks at the fund level taking board seats, right, their first layer of protection is that portfolio company's D&O policy. So really digging into that, because the devil is in the details, is paramount. Right, to ensure there's adequate protection. And then obviously, the fund will have its own layer of coverage, but I think that's a big piece that people often miss.
Yeah, that's a great point. So hedge funds, likely not applicable, but possible. Private equity portfolio companies would not be covered by the manager's D&O insurance to the extent that they're on the board of the portfolio company.
So actually, it's a little different. The first layer is the portco's D&O policy. The second layer of protection is the indemnification provided by the portco to the person taking the board seat.
Oh, okay.
And then third in line would be what we call outside directorship liability coverage.
Okay.
ODL coverage that provides capacity above and beyond the portco, so that if God forbid, the portco's D&O policy gets tapped out, right, the limit gets exhausted, there's still some modicum of coverage there.
Okay. So I think that maybe one of the faults that one of the ODD practitioners make is that they're only asking about, especially in the private equity space, which is what we're focusing on in this instance, about the manager's insurance. But really another question that should be under this insurance category is, manager, what have you done to complete due diligence on the portco's D&O insurance?
Because you never want portco issues, causing a stir up at the fund level. So again, it's an important piece to think about, because I think that even when folks do ask, it's just, hey, do you have D&O? Gotcha. And it's just to check the box versus really diving in and seeing what's in there.
Okay. When you're an ODD practitioner, you're often given a summary of the types of policies and corresponding dollar values of that coverage.
Correct.
As an ODD practitioner, what's the sort of back of the envelope way to determine, like, for a given policy type, what that manager's dollar coverage should be? So you can determine, even in a simplified way, like, is this adequate or is this sort of bare minimum? And
right.
Is it an AUM test, or is it the riskiness of the strategy? Like, how do you guys evaluate that?
So a while ago, the prime brokerage community came up with that 1% asset test, right? Carry 1% of AUM in terms of limit sizing.
And that would be for all insurance types or just D&O?
Just specific to the D&O and the E&O.
Gotcha.
What we've really seen increase in the last couple of years here is the rising outside counsel rates. So 5 years ago,
who are going to defend the manager if there's a claim.
Correct. Okay. So again, 5 years ago, $1 million claim may be $2.5 million now. So it really kind of comes down to what the fund is trying to accomplish, right? Are they trying to check a box because an LP mandated they need to have some coverage? Or maybe it's an outside director, right, in the Cayman Islands. That's one. Two, based off the strategy in the AUM and the LP base, do they really want to have something that's going to adequately protect them? And, if you're a long short equities fund trading in the TMT sector as a new launch, yeah, buy light, right? Increase coverage down the line. Don't have too much drag on the NAV. But if you're an activist, if you're a quant,
litigation risk,
running a bunch of money, and you have institutional investors, it's really, hey, do I have enough coverage here to protect myself? So what we like to do is, we've got hundreds of funds on the books. We do a ton of internal benchmarking all the time. So based off your strategy and where your AUM lies or where you think your AUM is going, we can let you know what your peers are doing. And again, there's no perfect formula here, but with senior partners now doing more of the work and charging upwards of $2,500, almost $3,000 an hour, it's been quite a jump in the past couple of years here.
Okay. One of the more emerging trends over the last few years in the insurance space in terms of products is cybersecurity insurance.
Yes.
My own personal sense was that a few years ago, there were concerns about purchasing it because maybe that if you unintentionally broke your own sort of protocols around cybersecurity, like clicking on a malicious link inadvertently, something like that, even if you had cybersecurity insurance, you would not necessarily get paid out on that because of the fact that you caused these issues. So, but I have noticed recently, it seems more and more managers are purchasing cybersecurity insurance. So can you just comment on, what do you think is the validity of cybersecurity insurance? Is that something everyone should have at this point? Or?
We like you, have also seen a large uptick in funds purchasing cybersecurity. I think that for the most part, it's mostly optics, right? Being able to check that box in your DDQ for $1,500 to $2,000 a year for $1 million policy, it represents real value.
Yeah.
And if it also happens to, help with a claim on the back end, great. However, I'm a broker, we're paid to place, we make commission, right, embedded in each policy. We historically had sold somewhat against it. Right? Because like you said, when you're filling out that application, you're attesting to a number of different internal controls. And the first thing the claims adjuster does when you file that claim is go, okay, here's a list of 30 things they said they're doing. Looks like they only did 28 out of 30. They never implemented multi-factor authentication. As a result, we're going to deny coverage.
Wow.
Because like you said, somebody clicking a malicious link, when you think about cyber claims, it's usually a failure of human process, right? Someone doing something that they shouldn't have along the lines that opened up
inadvertently, but still,
Pandora's box.
Consequentially, yeah.
But again, for the purposes of having something in place, having LP stop asking about it, I think that's been the large driver, because in the end, the asset management community, it's just not a real target for these cyber criminals, right? If you were a hospital, this would be a wholly different story. Funds don't take credit card payments. They have custodians for the physical assets.
They don't carry PII.
Right. They don't have a ton of PII, right? They have really strong counterparties. So for all these reasons, it's both hard to get at funds, and again, they don't really have what these folks are after. So again, I think the optics play is definitely a large part, especially because it's just been a conversation that's been running around the community for a few years here. But I wouldn't say there's a real macro threat, right, that is a big driver for all these funds to, go to purchase the insurance.
Gotcha. I think the other thing I'd love to chat with you about is there are some misunderstandings about that insurance will cover all sins. And, one of them would certainly be trade errors,
Correct.
Right? What can you tell us about if a trade error happens and, God forbid it was quite material in size, unlike sort of the ones that are typically in the few thousands of dollars? Would that be an applicable insurance claim that could be paid out, or is that something that's typically not covered by insurance?
It absolutely can, and it's interesting because the range of scope of coverage for trade errors can vary pretty differently between all the different insurance providers. For instance, some may require written instructions as a result, like to make the trade itself, right? We had an unfortunate incident with one of our funds that was a systemic trader. So the written instructions were in code, right? So that was a big deliberation point, with the insurance carrier as we were haggling over the claim. And the other big thing to think about is it going to cover just the cost of the error itself, or is it going to cover subsequent litigation, regulatory investigations? Again, we had someone trading natural gas futures. There was a
highly volatile.
Highly volatile. This happened in a very short amount of time.
Right.
and it was over a $10 million trade error. So there was the error itself. There was a CFTC investigation for market manipulation because the same trade had repeated so many times in such a short period of time. And then third, there was an LP suit, right, for not having a more robust trade error policy, right? Classic D&O claim, lack of oversight, lack of management.
So trade errors don't fall under E&O insurance, errors and omissions. That's under D&O?
So the reason why when funds buy, it's almost always a blended D&O/E&O policy is because it's very hard to unwind whether it's an E&O issue or a D&O issue.
Okay.
So the actual E&O issue error, right, would be the trade error itself, and the D&O claim being levied would be, again, the lack of oversight of the trade error policy or handling of the trade error policy. So that's why you see them blended together.
Want to chat with you also about like directors. So directors of the boards of the funds, they're typically covered by their own board insurance or the manager's insurance. Like, so like if a director works for Director Inc.,
Yep.
that they have insurance presumably, but then if they're the director of a fund, that manager's D&O insurance probably indemnifies or covers. How does that work?
That is correct. Really, anyone at the director level is going to be covered, whether it's an outside person or, someone truly, working at the management company level. So the beauty of the policies now is they have what we call omnibus language, meaning as long as folks fit within the definitions in the policy, no one needs to be named, right? And that extends to the entities as well. I think a large issue back maybe around 2008, 2010 was you had to individually list persons or fund vehicles in the policy. Funds are really busy, right? Say you're a large multi-strat, you're constantly launching new vehicles. And what would happen is a claim would come in and someone forgot to notify the insurance carrier that, hey, we're launching this new fund. Here's the PPM, right? Here's the size of the raise. So again, the community itself has gotten incredibly broad in scope, right, as it relates to D&O and E&O coverage. So there's very few limitations now. But again, just being aware of, what's out there and what's not out there is paramount. So,
Okay. In terms of, a lot of managers obviously have global operations.
yes.
Probably if they're domiciled in the U.S., have insurance in the U.S.
Yep.
If they have offices in far-flung locations and something happens in those locations that might be trade error related or operations related or something like that, will insurance claims generally pay out on those that are events that happen outside of the U.S.?
Absolutely. As long as coverage has been structured properly, and I would say most D&O policies, for instance, have like a worldwide coverage territory, absolutely. But again, ensuring that you, as the broker, have provided all the applicable information to the insurance carrier, right? Like, hey, here's their Dubai entity, here's their Hong Kong entity, here's an entity in the Jersey Islands. These are all these little pods, right? Especially, say, for a multi-strat. As long as they're presented the full picture, absolutely. But again, we do find from time to time that's certainly not the case.
Gotcha. In terms of like lesser known sort of insurance policies that might be something that we're going to see more and more of in the future, what are your thoughts about employment practices liability insurance? So
alongside the cyber, I'd say EPLI is probably the largest uptick in purchases we've seen in the last, call it 2 to 3 years. And EPLI is historically designed for employment-related matters like age and wage discrimination, wrongful termination, sexual harassment. It could be a hostile work environment.
Okay.
And it could be anything from, letting someone go over poor performance. You offer them, say, 1x their salary as severance. They allege some, crazy form of discrimination is the reason why they were shown the door and ask for 10x, right? You guys end up settling. So just having that policy there to either provide just the basic defense cost coverage as well as whatever the potential settlement or judgment may be on the back end is really useful, especially for funds with, tons of headcount. We typically see, those be a lot more applicable than, say, someone like a new launch that's got a ton of history together, right? The team's really lean and mean, but it's out there. And, there's some really sticky ones you can read about in the news, but by and large, most of these are just, settled. So having the insurance there is really important. And those typically pay out on settlements or on just litigation wins? Certainly could be either. Okay. And the other thing to think about as it relates to EPLI is if you're a fund and you have your benefits through a PEO like TriNet, they'll provide you some coverage, right? They'll maybe say there's $25 million available to all client companies with $1 million per client company available.
Okay.
The issue we've seen with that is the funds don't have any insight into the claims history. So that policy may renew on February 1st every year. A fund thinks they have coverage and goes to file a claim in May. TriNet turns around and says, that $25 million was exhausted in a month, right? So we like to have that as kind of a backstop. And what we tell funds to do is say, buy some EPLI as your primary coverage, and then we can schedule the PEOs as excess. If it's there, great. If it's not, at least you still have something in place.
Right. Matt, what are you seeing in terms of the future of the insurance industry with regard to investment managers, potentially new products, new ways of utilizing insurance coverage? What are your thoughts about that?
I don't think there's, say, new products in the pipeline, relative to investment managers. I think that alongside my comment earlier about the rising security rates, one of the most important provisions in your D&O and E&O policy is what we call UCR, right? Do you have usual and customary rates language in the defense cost section of your policy?
Okay.
If you don't have that, what happens is you file a claim and then you watch your outside counsel and your insurance carrier haggle over rates, right?
Okay.
Like I said, rates are, call it upwards of $2,500 an hour for senior partners now. Some insurance carriers are going to balk and say, I'll pay up to $2,000, leaving the fund with a billable hour difference of $500. That can be material pretty quickly there. So by having the UCR provision, it just means that whatever your engagement letter says with outside counsel, and they're going to have that nice rate panel in there, right? Senior partners, general counsel, paralegals. That's what the insurance company is on the hook for. Because what we've seen, again, is incredibly frustrating is the amount of time it takes for them to agree on rates. So a fund has something really hot on their desk from the SEC that they want to get working on, and they lose a week and a half, call it 2 weeks, until the rates are decided. So making sure that's in your policy, or pre-negotiating the rates and having them added onto your policy so that you can just point to and say, hey, this is what we agreed to, that's really key.
Yeah. Lots to dig into here. Lots of different types of policies, a lot of devil in the details type stuff.
Absolutely.
It absolutely makes sense to be reaching out to experts like yourself to help understand, are the investment managers that I'm invested in have the right types of insurance for when the unlikely events come, and unfortunately they do sometimes. So,
That they do.
But great to have you here, and thank you so much for your time today. Really appreciate it.
Absolutely. Thanks again.
Thank you.